Hey, everybody. I'll just give this a minute or so until everybody's got a chance to get situated, and then we'll start in just a moment. Hey, Tommaso. Nice to meet you. Eduardo. Thanks for again showing up. Jacek Alheji. Hopefully I didn't butcher that too badly. Yashvin. George from Brussels. Wow, I haven't seen you in a while, George. Nice to see you. So Marlene, we've got a lot of veterans from the Pattern Trader, a lot of members, Francis, Steve. So welcome to Duncan. So we have a lot of existing members from the Pattern Trader, and glad to see some new people. Tom, how are you? Ollie, and nice to see everybody. So I'll give this another, I don't know, let's give it another minute. All right, we seem to be leveling off, so I'm going to get started. So I'm going to play a short introductory video introduction, just kind of my background, a little bit of a summary of my philosophy. After you've checked that out, we'll go into the markets live and break apart what's going on. So with that said, I'll see you on the other side. Welcome to this 3-day live trade event subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shawson, the Pattern Trader. So we have so many of our members on this webinar. It's great to see the support that we have continuously turned out from our members. And for those of you who are new, let me just briefly introduce myself. My name again is Mark Shawson. I started the Pattern Trader in 2015, basically to educate people on how to recognize price action and price patterns. So I'm often asked the question, do I trade on the news? And the short answer is no. And I'll go into that in a little bit. Price is a discounting mechanism. Price is ahead of the news. Everything is filtered into the price. And so I just look at the price action on every asset class. So it doesn't matter if you're trading crude oil or pork bellies or the euro versus the yen or IBM stock or gold. You can use all of the technical analysis that I'll be talking about over the next several days. I started this business many decades ago when I was in college. I was going to one of the best business schools in the country, University of Southern California out in Los Angeles, and studying how to make investment decisions on what we call fundamental information. So fundamentals are when you look at a company and you break it apart and you look at the price earnings ratio, you look at the sales to, inventory ratio, you look at the management. If you're looking at a cocoa market, you're looking at exports, you're looking at the dollar. So you're making investment decisions based on what we call fundamental information. But to me, the markets are a forward-looking mechanism. The markets are always looking ahead. And so even if you can see information today, the market is not looking at what the information is today. It's looking at what is the information going to be next week, 3 weeks from now, 3 months from now. And this is why I study price and price action. So again, my abiding philosophy is that price is a discounting mechanism. And what does that mean? It means that price is effectively ahead of the news. I'm going to show you some charts where for a year and a half, I was predicting that Tesla was going to fall from $1,200 to $400, that it was basically going to drop by 3/4. And that's exactly what we saw last year. Now, Tesla was adjusted. It was split 3 times. And so it's trading at about $100 now, and it fell from $400. So Tesla was down 70% last year. Now, I was saying to our members for a year and a half prior to Tesla collapsing at the end of the year that this was going to happen. Now, how did I know that? The only way I could know that was by studying price, and price is ahead of the news. So we can say that, Tesla crashed because Elon Musk took over Twitter, but that was only late last year. The price patterns and the price action was telling us that Tesla was going to crash, and the reasons always come out later. The why is not important to me. To me, it's where, when, and how much do I have to risk on any given position. So to me, amateurs trade stories, but price is the only truth. When we talk about stories, I remember looking at CNBC one day, and Kevin O'Leary, Mr. Wonderful from Shark Tank, was, telling us about Zoom. I was short Zoom, and it was right before the earnings. And Kevin O'Leary came on and said, you've got to think of Zoom as a new telco, a new paradigm, a new way of communicating. And so I was short when he was saying, this is, just a new paradigm. And, this is the conflict. When you look at news, you get you get confused. So this is why I say you have to be objective. There are all kinds of information swirling about the investment markets today. How hard's the Fed going to go? Are we going to have a recession? If we have a recession, is it going to be a soft landing or a hard landing? What's going to be the terminal rate? When's the Fed going to pivot? We've been hearing that conversation every hour, every day, every week, every month for the last 3 months. And you cannot make objective trading decisions based on listening to that. So there are going to be all kinds of things buffeting the markets this year, the Fed, recession. And so you have to be entirely objective. So to me, price action is the analysis of price charts, and it helps us define two things: objectively define where to enter a position, and then objectively identify levels to manage your risk. And that's the holy grail of trading. If you know where to enter a trade and what your risk is, you've got a good deal of this game beat. So to me, the advantages of price action is that price action tells us where on the charts to buy or sell without second guessing ourselves, how to establish optimal entries and exits, and how to protect your account and maximize your profits. And by using price, you can diversify and trade in bull or bear markets, trade markets that are going up, trade markets that are going down, and you can trade any asset class. So you don't have to have specific fundamental knowledge on how a treasury bond works or how the euro yen works. So you can diversify across foreign exchange, stocks, gold, oil, commodities, and whatever you want to trade. If it has a high, low, and close, I can trade it. So I basically put together a few thoughts on how to achieve consistent profits over time. Obviously, putting on a trade is effortless. We all have screens and fancy technology, and it's fun putting on trades. But it's all about having the discipline. And what I try and do is hone in on the best risk to reward opportunities. Those opportunities that have a 3-to-1 risk and reward. And that means if you're going to risk $5 on your stock, you should see a pathway to make $15. And you can lose a lot of trades if your risk reward is 3-to-1. Now, to me, the biggest problem in trading is discipline and being unemotional. And I struggle with that. So I've kind of built this rule. I built the framework for the pattern trader really around myself to help myself give myself governing principles to keep myself out of trouble, because I will trade a 5-minute chart. I'll trade a 1-minute chart. I'll trade a 4-hour chart. But to me, I feel if you stick to the longer term timeframes, daily, weekly, monthly, this will give you bigger moves, bigger outcomes, and eliminate all the ups and downs. Now, I've also found that either buying immediately within the first 15 minutes of a market opening or on the close is the way that I have found that, avoid all of this emotional intraday trading. And intraday trading is just gambling. When you're looking at a 15-minute chart, a chart can go anywhere in the next 15 minutes. Yes, you can spot double tops, double bottoms, and all the things that I look at. But the thing is, they won't sustain on a 15-minute chart in the same way that they'll sustain on a weekly chart. And also, I think that we're all humans. We're not bots. So I try to limit my trading to no more than 3 positions at any one time. I can't keep track of all of these things. And certainly when the market starts swirling around, it's very, very difficult to keep track of it. So the idea is to find the best trading opportunities with the best probabilities. It's not quantity, it's quality. And then it really comes down to risk management. If you protect your risk, and especially in the FX market, if you limit your risk to 0.5% per trade, you can lose 10 trades in a row and only be down 5% in your account, where most people are trading too much and risking too much on each trade. And it's all about controlling the risk. So at the end of the day, it comes down to being in control. Wait for the market to come to you. If you find you're chasing trades, if you feel like you've missed something and now it's going and now you got to jump in, you can feel very quickly that you're out of control, that you're in a reactive mode. So to my mind, the way trading should be is that you should anticipate, understand what the market's telling you, understand the price patterns, and anticipate where prices are going to go. If you find that you're reacting, this is where things are likely to go off the boil very, very quickly. So if you follow these principles, there's no reason that you won't be hugely successful. And that's what I try and do at the Pattern Trader, is give you the education and give you the tools to become highly successful. We have a Trustpilot page that you can go and look at all the testimonials from hundreds of our members around the world. So it really boils down to a 4-step trading methodology that has taken me decades to figure this out. So the first thing, when I open up a chart, I want something to jump out at me. If it doesn't jump out, I just move to something else. So when we open up a chart, basically what I want to see is this market going in one direction or another? Is it in an uptrend, or is it in a downtrend, or is it just a sideways channeling market? Now, there are 2 other variables to an uptrend, downtrend, and sideways market, and that is a market that is turning. One that's turning from a market that's been bullish to one that's bearish, or turning from a bearish market to a bullish market. And frankly, that's where I make a lot of my money, on the turn. Today, the Dow Jones went up and started turning lower, and I made all kinds of money on that turn. I'll show you what I did in just a moment. So the way I identify a market that's going to turn is that there's always what I call a governing price pattern. Before a market turns, there's a price pattern, a head and shoulders, a double bottom, an inverted head and shoulders. There's always some price pattern that precedes that turn. And then I try and corroborate what I feel like I'm seeing in terms of the pattern with what I call the price action. And there are 2 forms of price action that I've coined an insurance bar. An insurance bar can be on a daily chart, a weekly chart, or a monthly bar chart. And they come in 2 forms. One is a key reversal. And again, I'll discuss this in more detail. And this is what we saw again today in the Dow Jones. Dow Jones made a new high, close on the low. That to me is what I call a key reversal, where it goes higher and closes on the low of the day. Another form of an insurance bar is an inside bar. And I'll show you a chart today with an inside bar that I think is a tremendous signal going into tomorrow. So once I kind of identify the trend, then the chart pattern, and then I drill it down to a certain day where there's a turn, a key reversal, or an inside day bar, then I look to confirm all of this analysis. So all of this analysis is really very subjective. It's my way of looking at things. And ultimately, I want the market to confirm what I'm looking at. So my philosophy is the market is always right. I'm right some of the time. The market is always right. So I'm always looking for the market to confirm what I'm thinking. And so if I'm looking to buy a market, I'll put a buy stop slightly above the high of today's range. Or if I'm looking to sell short, I'll put a sell stop underneath the inside day bar or underneath the key reversal. And I'll go into this in real time. Hopefully this will make more sense as we go along. So these were some of my predictions in Tesla, going all the way back to January of last year, where I started talking about Tesla as an implosion. And this was when Tesla was still trading at the very highs of its trading range. So now Tesla has split 3-for-1 since this time. So it's, basically on a split adjusted basis, it would be trading at $300. But Tesla's trading at $100 in the market. So it's gone down 70% since I started telling our members to sell Tesla. And all through the year, I was saying short it at 1,000, short it at 800. Even, the end of last year, where it was trading at $187, this was in November. A month later, Tesla dropped to $100. So you could have made almost 100% just on that one signal. Okay, so with that said, there was a lot of hubbub as to whether this was a live presentation. It is a live. I just wanted to give an introduction. I wanted to give a basis. No use just me running into the market without you guys understanding what I'm doing, why I'm doing it, and a perspective. So I was trying to, give you some kind of background. As I always do, I always kind of go into what I'm doing, just to kind of give you perspective. I'm a full-time trader. This is what I did in the markets today. I bought call options in the stock of Workday. I bought them at $2.40. I blew out some at $3.65. I made 53% on the day. And then last week, based on recognition that the markets were likely to rally, I started buying spot indexes. So the S&P 500, the cash market, I started buying. The 100 is the NASDAQ, and then I'm short the dollar versus Canadian. So I had a pretty good day based on the rally. I was actually pretty conservative today. It's my son's 21st birthday, so I was kind of, caught up with events there. So usually on a rally day like today, I go pretty crazy. But this is some of, the trades that I've done in the past. Where I send emails to our members, everything I'm doing, I try and educate them, showing what's actually transpiring. So this is not a signal system. This is not a managed account. What I'm trying to do at the Pattern Trader is educate, give our members the tools to make these decisions no matter what's happening in the market. So this was, an indication to sell the New Zealand Canadian, not a pair that I normally trade, but it had a setup that I thought was going to really result in a good profit, and it did. And then, I'll add to a profitable position, and then, it can become pretty profitable. I made over 6 figures on that trade. And then in gold and silver, I kind of hit it out in the park on these, made multi 6-figure trades. Dollar yen, euro yen. This was earlier in the year, and they had huge bust outs. And this is what I'm looking for on my trades. Now, this doesn't happen every day, every week. The market has been pretty topsy-turvy, pretty all over the place. There's been so many themes and sub-themes buffeting this market, and I'll try and unpack what I'm looking at, what's happening currently. The purpose of the next 3 days is for me to introduce to you a way of looking at the markets, an introduction to a way of looking at the market through price, not through a prism of information, but price structure. So it doesn't matter what these charts are. It could be natural gas. It could be a corn chart. It could be, dollar yen. I just look at the structure of price to see if a market's going to go up, down, or change a direction. And so again, what I'm going to try and do over the next 3 days is show you some examples. Now, we can't go into hundreds of charts and hundreds of things. If you're interested in what we do at the Pattern Trader, I'll send you a link that you can sign up and register. And we do something every Friday, what's called the Underground Sessions, where I look at the most opportune markets, and then members in the Underground are then able to ask me all kinds of questions on different charts and what have you. But for the purpose of the next 3 days, I'm going to start today by looking at stocks, what's happening in the US stock market. Tomorrow, I'll look at gold and silver. And then on Wednesday, we'll go into the currency market. So I'm going to try and structure it that way. So again, I can anticipate there'll be tons of questions. Please look at that. Please look at this. And you'll be missing the point. What I'm really trying to do is give you a way, an approach of looking at a market. And if you're constantly looking to search me somewhere else, then you're missing what I'm trying to say. And it's very subtle, very important what's going on here. There's a lot of nuance, and there's a lot of things going on all at the same time. So instead of getting distracted with 1,000 charts, I'm really going to try and delve into what's going on here. Now, I think before I do that, I kind of just want to share with you, some of the emails that I started sending a couple of weeks ago, because I don't know if you remember in November, December, most every analyst you listen to on TV, everybody was positioned on one side. Everybody said the first half of the market's going to be really rough. S&P is going to be way down, and then the second half's going to be good. Almost everybody, there said that. Now that really bothered me. When everything's kind of weighted to the one side, then you get a chance of being really off sides. And this is what's happening. So we basically had a rally for the first 3 weeks of this month. Everybody thought we were going to be falling off a cliff come the 1st of January. So this is, again, education and what I try and convey. And I said over the past few months, the majority of analyst pundits and overall trading sentiment has been heavily weighted on the bear side for stocks. While it's still possible the secular bear market trend that we've been in for the past 12 months could reemerge, I'm also seeing the possibility of green shoots in the market. When sentiment is so heavily one-sided, it raises the possibility of the market to be caught off sides. And who knows, a FOMO, a fear of missing out rally, could emerge. So I was already talking about this concept of, people being very weighted, and that, in trading, you have to be open to all possibilities. When we hear pundits and experts, Jamie Dimon said last year that the economy was going to go off a cliff. Everybody said we're going into a recession. It was so heavy-handed. And that, to me, just, through the fear of God, this is just wrong. When everybody's waiting on one side, it usually doesn't happen. Now, this is an email that I sent out January 11th, 2 weeks ago, and it was in Qualcomm. And I said, this is a buy, that we've got emerging bottoms in this stock. And so once you understand and recognize the patterns, then you can understand, where prices are likely to go. So now Qualcomm is now trading 2 weeks later at 131. So today, I'm kind of shifting around here. So what I'm saying is that, anybody can handicap, markets today and say, well, this is what I should have done, and this is what I would have done. What I'm trying to do is show you emails that I sent weeks ago, anticipating what we're seeing today. And it's not magic. The markets put on certain patterns, and those patterns precede price action. So when I said buy it at 118, you're now at 131 2 weeks later. Now, there was a set of patterns here that indicated that that was going to go that way. Now, yesterday, I sent out an email. And I said, the Dow Jones has rolled over from a key resistance level. And I said the S&P and the QQQs, which is the NASDAQ, appear poised to break out above the key downtrend intersects. So this was yesterday. So we had a big rally today. And I was saying that the S&P and the NASDAQ are poised to break out. above their downtrend. And that's exactly what we saw today. So again, this is not magic. I said we could see growth stocks like Workday, Qualcomm, and Microsoft catch a bid. And they all did today. Qualcomm was up huge. Workday was up, Microsoft. And I said, while value stocks look like they could have hit a wall. And so here was my call on Workday. I told our members to put a buy stop at 173.5. And today I think it closed over 176. So these are the kind of instructions and education that we feature at the Pattern Trader. And again, most people will just focus on, well, what did this trade do today? And if you do, then you're kind of missing the point, because it doesn't matter if it won or lost. It's why we did that trade. And then I learn more from my failures than my winners. So if it doesn't work, then, you know, we go back and say, okay, why didn't it work? And so when you start getting these emails, you can start building a living archive and see the patterns that worked in the past, and they tend to reoccur. So with that said, you know, let me kind of get into the markets. And what I've done is I've put a couple of indexes in front of us here. The first one is the S&P 500. It's a major stock index in the United States. The middle one is small cap stocks. This is the Russell 2000. And then on the lower graph is an ETF, an exchange traded fund called IGV. Now, the IGV is basically encompasses all of the tech stocks and mostly Microsoft. So tomorrow, Microsoft has earnings after the market. And again, this tells us how, you know, the market is ahead of the news. You can see that, you know, the IGV is already starting to catch a bid. Microsoft did. And so this is going to be a very telling week. Microsoft tomorrow and then Apple on the 2nd. Between those two huge cap, we will start learning, is this market, you know, kind of a fake bear market rally, or are we starting to trigger a new trend? And frankly, I've been on the sidelines for a while. I can see the possibility of both, but this is why the market tells you what it's going to do. So what I try and do to create trading opportunities is that I put a structure, a boundary around prices. So you can see that the S&P's kind of formed this funky kind of triangle, this megaphone top, whatever you want to call it. And now we're at this proverbial point of inflection. And inflection by definition is that, you know, it could go in one direction or another. And this is a, you know, very tricky area. Everybody's watching it. Everybody knows these levels. And so I do think that it's going to get a hair above here. We're trading at about 4,000. I think we get to 40, 100. We might even get to 4,300. I do think that there looks like there's room to run, on this trade. And that's why I kind of started burrowing into these indexes today. Where is it? So yesterday, on Friday, I started buying the S&P at 39.40. And you can see today it's trading at 40.20. So, I was already anticipating that this thing looks like it's catching a bid. And now the question is, does it bump into the roof of this thing and go there? Or do we still have more left on the table? So I think it could be both. It could rally and it could still fall out of bed. And that's kind of the trick of trading this market right now. You kind of have to trade on the long side with one eye open. But these rallies in bear markets can be extensive. They can be sharp and extensive. But this one looks a little bit different to me. This one looks like it's a trap. So I said at the outset, I tell you guys how to identify the opportunities, but also the trap. So this looked like it made a low here. So actually, let me kind of draw it this way. Kind of like a descending triangle. The only thing is that, now it's starting to sneak out the top without kind of coming back here and retesting it. Now, I'm still very suspicious of this move. And, I think, again, we could go 4,100, 4,200, still 5% higher, and then still run in trouble. And I think, again, this week, we're going to learn everything. Microsoft tomorrow and Apple next week, and then we'll also have the Fed. So Apple will be on February 2nd, and the Fed, I think, is on February 1st. So we've got these huge kind of event-driven things that then will start giving us clarity. But either way, what I do is I draw a boundary, and then I just start setting up risk reward. So you can see that we're starting to catch a bid higher in this thing. And I just started buying it on Friday on the premise that I think this rally is going to extend. Now, the middle chart is the IWM. These are small cap stocks. And this is also looking like it's starting to break out. So you can see that we have this very entrenched downtrend, this descending pattern. And this is how these patterns, I've traded these descending wedges long enough. The descending wedges, when you go into these sequences, and it typically does that. But what the market does along the way is it traps you. It makes it look like it's crashing toward that level. It stops short. And when it comes out the other end, it could open itself to a big rally. And everybody is so bearish now. Nobody's been able to envisage a rally that, to my mind, we could have a huge rally here. Like I said, I go back to my email 2 weeks ago. You have to be open to all possibilities. So right here, we're treading water also at a major. So there are a lot of confluences here, a lot of things where you're starting to break out of the long term. You're right at this resistance. And so this is just, you can understand, a very pivotal area. Now, sometimes you can get these fake outs where he sucks you in and then goes back in. And if this thing kind of came back under here, I would understand that. So to my mind, I look at the lines, I look at the structure, and then I look what the market should do, and then I look at what the market is doing. So here you've got these descending patterns, and you're starting to break out. With all this fear talk, all this recession talk, the markets, remember, are a discounting mechanism. The markets are ahead of the information. Now, the most kind of market that has really languished has been tech, where we've seen Amazon and Google and Facebook and Netflix get, face planted. But you're starting to see that we're breaking out. We're breaking out of this long-term trend line. And there's also a pattern. So this has been the conflict for me. Is we've been really since May. S&P, was 3,800 in May. It's 4,000 today. We've been for 5 months locked up, especially in tech stocks. Back, forth, nothing doing. And, when you're at, in this area, you're saying, okay, well, I'm always looking for a move that is going to be a bigger move, right? Very difficult to make money carving out, $5 up and $5 down. This is where you lose most of your money. What I try and do is take a piece of the middle on moves that move up or down. So I'm looking for movement in the market. When the market goes stillborn, this is where life becomes very difficult. So I'm always looking for the trajectory that we can hop a ride on a nice move where it goes 4 or 5 weeks directionally. And, unfortunately, the last 6 months, there's been such a push and pull that it's been hard to do that. But we are now on the cusp of a breakout. We're breaking out in the S&P, slightly breaking out in the IWM, and the technology that was lagging is starting to catch a bid, and it's already breaking out. This is the IGV. This is the ETF. It has Intuit, Microsoft, Salesforce. Salesforce was very strong today. And so the question is, is this real? Is this just a bear market rally that's just going to fade like all the other ones, or are we going to start something here? And that's been kind of the constant push and pull, because this all started with this pattern. So that is, it looks just like a man or woman's left shoulder. This is the head, and that's the right shoulder. And then when it crosses through the neckline, we know that this bear pattern has been confirmed. So this is a head and shoulders reversal pattern. And what that said at that time was that leading up to this was an up market. And once we see a bear pattern, we know that it's going to go the other way. So now the question is, have we gone down enough? And that I don't think is really even the question, because sometimes these bear market rallies can be unbelievable. You can rally 20% and it could still be in a bear market. So again, the idea is we're just trying to hop rides. And the danger is that, do you try and get a ride and then it just rolls over, in your face? And so that is, you can see that right here. So, I said that I look at a combination of patterns and price action, and maybe this is a little small. You know what? I'm just going to blow this up so we can look at this a little bit more carefully. So this is the IGV ETF, and this is a weekly chart, which means that each one of these bars represents 1 week in time. And this is what I kind of counsel our members, is to look at the bigger time frames, daily, weekly, and monthly. Why? Because I'm trying to find patterns that indicate bigger moves in the market. If you're looking at a 15-minute chart, you can only see the last 6 days and you don't know what's coming at you. On a 15-minute chart, that may look like a huge rally, and you're getting sucked in right here because after going up for 3 days every 15 minutes, it looks so good that you get sucked in. But if you understand what the cards you're holding, you're in a much better position. And so up here, there was really 2 major price patterns that indicated this was going to roll over. And I said so right at the time that it did. There was another obscure price pattern that even if you hunt through your technical trading books, you're probably unlikely to come across it right away. So right here, this is called an ascending broadening price pattern. You can see throughout this price pattern, prices are going up. It starts out narrow and widens or broadens at the top. Now, the magic about these price patterns is once they bust, we know exactly where they're going to go. To the bottom of the pattern. So now the dollar index is in this ascending broadening price pattern. Apple formed an ascending broadening price pattern, and we're trading right here on Apple. So the question is, sometimes these patterns, you can't just look at them literally like in a textbook. This one moved in a textbook fashion, but you can also see, like gold did, where you move in this ascending broadening, you can take this out and then you can go the other way. So it could be a continuation. So the question is, are these reversal patterns? Are they continuation patterns? And that is what the market throws at you. And I'm pretty good at sorting them out. And this is what I help our members with. But now we've had a combination of these bear patterns. And to my mind, I don't think this is going to, turn around in a V-shaped bottom. So I'm very suspect. But you can see that these bear market moves are very sharp and very long. And you could get an extended one that, goes quite a bit. You can make a lot of money on this before it indicates the ride is over again. So this is what, sometimes it's easy. And for the last couple of months, it's been really, really difficult. So here we see this double bottom. And then we look for confirmation of the bottom, which would really be above this area here. So this is why I said in my newsletter over the weekend, this 280 is very pivotal. And this is also why Microsoft is going to be very pivotal tomorrow. So the question is, by Wednesday, do we see this thing, broken out? Or do we see a fake out where Microsoft goes up or whatever, and then, we're down here. So this is going to be very telling, but we're at this kind of inflection point where we're about to now start breaking out and perhaps opening up to a nice big rally. So this is how I break apart charts. What I try and do is, whatever the chart is, I go, okay, what's going on in this chart? Is this an uptrend or downtrend? So this wasn't an uptrend, then it had a reversal pattern, and now it's been in a downtrend. But now the question is this a reversal pattern that's going to give this enough gas in the tank to, make a nice move here? And it looks that way. It looks like we could be really surprised by a huge rally here. And so this is how I look at charts. I look at structure and price action. And what I mean by price action is that I always say that the markets actually point in the direction they want to go. So the first thing I look for is the market in a trend? One way or another. Is the market going up? Is the market going down? And then you want to get in sync with that trend. Buying key reversals. And what I mean by key reversal is when a market makes a new low and closes on the high. You can see every time this thing made a new low, closed on the high, it made a new high. So when the market's going up, you use, a series of these price actions just to get in sync with the trend. And when the market's going up, it's pretty easy. It's these things where the market is thrashing and indicating that it may turn or it may dump. This is where it's difficult. So you also have to understand and consider the market environment when you're trading. And I'm always looking for flushes like this, where I can take moves out of the market. When it gets jammed up like this, you just have to, exercise extraordinary patience and wait for that opportunity. But once I understand what's going on, and what I mean by understand what's going on is that, this market went straight up, but at some point it started indicating that it was going to turn by this head and shoulders price pattern. So when I start seeing these price patterns, I start noting, hey, this looks like a head and shoulders. But then I'm waiting for confirmation. And to me, the confirmation comes in the form of what I call price action, what I call my insurance bars. My insurance bars are: one is a key reversal, bar, or an inside bar. Sorry about terrible writing. So these bars, why I call them insurance bars, is that they tell me how to join a trade and how to assess my risk. And to me, that's the holy grail of trading. If you can understand where to get in and where your risk is, to me, trading is all about understanding risk. And I try and find trades where I can find this little coil, where I can feel the energy and I can see that my risk is almost minute for a much bigger outcome. So what do I mean by key reversal bar? So you can see all along the way here, trying to search for some color that's whatever. You'd see that right here. This is a weekly chart, right? So this is a a price range for an entire week. So you can see in this bar, prices went higher, but by the end of the week, it closed on the low. And it was preceded by this bearish pattern. So now I'm saying, okay, I think I see this bear pattern. And now I'm going to wait for the market to give me an indication on how to, trade this market. So to my mind, what I would do is put a sell stop order, a resting order right under that low, and put my risk right above that high. And you can see if you did that, you would have gone for a tremendous ride on the downside. And this is what I'm looking for. I'm looking for a combination of these patterns and price action that give me these moves. Some are smaller than others, some are really big. So here's another key reverse. So you can see all the way down here, made a new high, close on the low, made a new high, close on the low, made a new high, close on the low. And every time it was preceded by a new low. Now, at some point, you just can't trade key reversals in a vacuum. Once a trade's come all the way down here, taking this key reversal here into all this kind of chop is very different than taking this reversal here or here. So there's a time to hold them and a time to fold them. But this is an example of how I use price action to suss out moves and contain my risk. So now I see another pattern here. And the question is, is this a real pattern? Is this a pattern that's going to break through here and be a sustainable move? Still an open question. The more their fear is and the more suspicion there is, this is just going to keep climbing a wall of worry. So that's what I look for. So I'm just going to talk about two charts here, and they kind of look very similar to each other. So I've been looking at Qualcomm and Microsoft for quite some time because they exhibit pretty much very much of the same characteristics, although Microsoft is not as clean. So again, all I'm trying to do is give you a way of looking at the markets today. I know there's probably going to be a ton of questions. Tomorrow, I will kind of put my book, it's a pay what you want, that explains my 4-step trading process in much greater detail. So I'm going to kind of start by looking at Microsoft and Qualcomm on the weekly chart, and then I'll drill it down to the daily chart. But first off, what you'll notice is there is no moving averages. There's no Bollinger Bands. There's no MACD. There's no volume. There's nothing on this chart except price and time. So we call this a clean or a naked chart because there are no indicators on here. And I just use a picture like this to understand risk and reward and determine how to get into things. And I make a lot of money doing that. So when we look at these charts, you can start by saying, okay, here was a pattern, this double top at 190, and from that prices went to 100. So this dropped by 50% after this thing topped out. And now the question is it putting on a bottoming pattern that's going to, result in a nice move the other way? So I started seeing this bottoming pattern on the daily and the weekly, started telling our members about this in the low 110 area. Now we're at 130. So you can see that we've also been trading in this channel, and we're breaking out of this channel. So you can see that all of these markets are starting to break out. So when we're trying to figure out the news and the Fed and interest rates and whether we're going to have a recession, the markets are already doing that for us. We won't know if we have a recession or not, or how hard it'll be or whatever, but the market will be up there by then. By the time you figure it out, or it's, in the Wall Street Journal, the markets are ahead of the news. So you can see that we were in this huge, beautiful channel. And just like the S&P and the Russell and whatever, is that you came down here and then you stopped short, and now you're starting to sneak out the top side. So now it suggests that these growth stocks, these technology stocks that have been beaten up, could have a lot of room to go on the upside. You can see we just broke out of the resistance today, and now it's just flashing all kinds of buy signals. Now, this is a little bit ahead of Microsoft. This is kind of the same chart, and it could be just previews of coming attractions. This is like kind of maybe giving us an insight on how Microsoft's going to trade tomorrow after the news. You can see it's the same looking chart. Channel, bottom, rounding bottom. Channel, bottom, bottom. So now it looks like we're going to 260. At least a bang in the upside of this channel, and perhaps even higher. So, if you're a gambling man ahead of tomorrow's news, you may want to just buy some here. Now, it could go either way, but this seems to be like a preview of coming attractions here. Now, when I said Qualcomm's a little cleaner, you can see that Qualcomm had this very clean resistance line. So this is, why I will decide to try one versus another. So you can see that Qualcomm has this very clean thing that after it clears this, there's like nothing, above there. But you can see where Microsoft has this guy in its way right here. So, I look at all the price history and what have you, and you have this kind of still in your way. But notwithstanding, this is trading in a very clean channel. And to me, it just feels like it needs to bang the upside of this channel one way or the other, which is around the high 250s. So that's what I'm looking at. We'll talk about that, kind of tomorrow. Now, the market is a stock market, is a market of stocks, not a stock market. So there are some that are going up, and technology looks like they're, going up. And then I don't want to take too much time because I want to, answer some questions here. Maybe I should just answer some questions here before I kind of go on. Simon says, when placing stop loss on the daily chart, what do you suggest, 50 or 100 pips? How do you determine them? So it really depends on the price action, right? So let's see, I had a buy on Workday on Sunday. But that was probably on the weekly chart. So what I do is just based on the price action. So if you just put 50 or 100 pips, it's arbitrary. I try and look at where is a reasonable point, where prices, if they reverse through. So what I try and do is I try and look at an area and say, okay, here's a double bottom. So we're starting to see that this has got this inverted or upside down looking head and shoulders. Then we cross the neckline. Now we retested it. Now we've got another bottom. And you can see right here, these to me are slam dunk trades. You can see both these days, you had a key reversal price action. They made a low, and then both times they closed on the high of the day. So you have this double bottom key reversal. So to me, it's like a no-brainer. Buy here, put your stop loss there. So it's not a function of arbitrary, put it 40 pips away or whatever. And that's, I think, what people are doing. They're saying, I'm going to be a good boy. I'm going to get in this thing and put a 15, pip stop loss. But if the volatility is too big, you're just going to get taken out and die a death of 1,000 paper cuts. So I try and see the bigger picture, and I think that Workday is going to, go back to 200 here. So why do I want to get diced up by some arbitrary stop? Tesla could be setting up for, you know what? I'm just going to stay on point, Mitchell. I want to just answer questions on the methodology and on the charts that we've talked about, and instead of getting off point. Um, Phil says, are these emails only for paying members or people who are interested? So these are for our paying elite members, Phil. It's a program called the Elite. I'll flash the email on how it's, if you want to trade with us tomorrow. Let me actually try and get that now. If you're interested, here is how to join some of our programs. Just shoot us an email and somebody will get in touch with you. But thank you for asking. What's your typical plan if an option begins to go against you? Well, the good thing about options and the bad thing about options is that, options, you risk the entire amount. So on Friday, in anticipation of this move, and then actually when it opened lower today, I started buying calls in. Calls is a bet on the upside. I bought the 175 calls, which is right here at this strike price right there, for $2.45. And today they're probably trading at around $4. Where's Workday? So I got in at 245 and the 175s are trading at 370 to 385. So I made 50 to 60% on those that I bought today and Friday, and then I still got some left over. Let me ask you, I'm thinking of starting an options program. Is there anybody out there who would be interested in trading options? And I'm going to make it very, simple. Mitchell says yes. I'm just going to do puts and calls. Devendra. So Richie says absolutely. So there's a lot of interest. Joey, Henry, Sebastian said he's super interested. Yes. Ashkan, Sean, Jasek, Eduardo. So again, what I look at options is that I buy or sell options depending on if I anticipate a big move and a big move quickly. So tomorrow I'm planning, even though I think we're in a bull market, tomorrow I'm looking at a couple of stocks where I'm hoping they open higher, and then I'm going to buy put options into a higher opening. So there's a sector, the consumer cyclicals, that I think is starting to show like it's starting to peter out. So even though the markets are going up, you can see that there are other markets that are starting to turn and go down. So this is how I use patterns and price action and how I use options. And I only do this in a certain way. So on the top, I've got Procter & Gamble, ticker symbol PG. And on the bottom, I've got Pepsi-Cola, ticker symbol PEP. And again, it doesn't matter what these charts are. It could be, soybean oil or, pork bellies. I would still look at them the same way. And so what I'm seeing up here is a combination. You could call this a rectangle top. You could call this a triple top. You could call this a head and shoulders. But whatever you call it, it's got the word top in it. So if this market has topped, it's going to do what over time? It's going to do that over time. So once I understand what this market is telling me, now I'm looking for cues on how to get in this thing and how to assess my risk. So here is, and this is in real time. This is today's action. So if you're asking if this is what happened today, Procter & Gamble made a new high and closed on the low. So now I think this market is topped, and now we have a key reversal. So what I'm going to pray for is that tomorrow, I hope the market opens strong and we get a higher opening in Procter & Gamble that, opens up, goes from 141 to 142. And then what I'll do at this point, in anticipation that this thing is going to keep going down, is that I'm going to buy options. I'm going to buy a put. So the selection of what strike and what have you now, this is Procter & Gamble. It's not a huge moving stock, although it did move a lot this week. So I would buy as close to the money as possible. So let's say this thing is at 142 tomorrow. I might do the 142s. I might do the 141s, 1.5. So let's say for argument, so let's say the 141 puts today close at 120. I would probably buy closer to the money. You always want a big move and what have you, the safer thing to do. So you have to pay more. So let's say that this thing rallies to 142 in the morning. And let's say this premium goes from $1.70 to $1.20, because this is going to rally. So this is going to lose value. A put makes money when the stock goes down. So what I'm going to try and do is, and I'll only do this if it opens higher. If it opens lower, the play is gone. It's gone. We'll look at something else. So I try and use the energy. So I want the energy to open higher, take advantage of that, and then a slingshot. And then if it goes lower, then these things will go from $1.20 to $2.20, and I can make 100% of my money in that kind of trading action. The same thing with Pepsi-Cola. So I'm looking at this whole segment as, something that is turning. There's an ETF called the XLP, and that's the ETF for this whole consumer discretionary thing. And I think this whole thing is turning. I think it's put on this rectangle top. This is Pepsi-Cola. And then you also have this, head and shoulders, whatever you want to talk about. This thing looks like it's poised to go lower. Now, you also have this key reversal today. Now, you've already had a pretty big move. That's kind of the problem. That's why I would only look at kind of an extraordinary rally to get short. So this closed at 169. This thing kind of goes to 170.5, 171 tomorrow. I would take a flyer at buying some put options. This actually looks a little bit better. I like PG a little bit better. So depending on the price action, depending on what I'm looking at. But the point is, I'm looking for a move, and with, put and call options, you want an immediate move. So I want this thing to open higher and then do that. And the good news is I could probably make 100% in a day. The bad news, I could lose all of my money. So you have to know that you stand to risk 100% of whatever you put in the middle. So, if I'm going to pay $1.20, that's times 100 shares. So you have to invest $120 for one put or call. And you could lose the whole thing. So that's the offset. But, if it goes to $1.70, take half off and you've made 50% on your money. So I look for these big moves, and I've taken options from $1 to 14. I've taken options from $1 to 23. Those are fun moves. So that's what I look for. But, around this kind of area, I'm just looking for $1 to go to 2 or 3. It may go to a lot more. Now, it also depends on your expiration. So these are all by the end of the week. So, you've got 4 days to be right. So that's what I do. How long do I hold trades for? Phil, it really depends on the environment. This has been a hair trigger environment, so that, I'm in and out more quickly than I want. I'm really looking for trending environments where I can take a piece of the middle out of a 3-week run. So it all depends on the market. So a lot of interest in options. I'm going to think about it. I didn't want to introduce people to a lot of risk, but actually options are a way of limiting your risk too. So as long as you're careful and you know that you're limiting, but the thing is, if you're short a stock, you're open to almost infinite risk. Whereas if you buy a put, your risk is limited to what you put up. Well, this looks pretty bright. Sebastian says, thank you. Unequivocally trade and explain in the clearest manner I've seen across all platforms. So Sebastian, I'm going to ask you for a review, in 2 days, and just remember what you said. I'd like you just cut and paste that in our review website. Roger says, how far out of time do you buy options, Roger? It's really depending on what I'm looking at the time. So I buy a lot of triple Qs, which is the NASDAQ. I do, if I want to buy, if I want to bet on the market, really what I do is a lot of options in the triple Qs, and then the S&P and the Dow Jones, SPY, and then the DIA. So, because this market's been so whippy and individual stocks have been, kind of difficult, if I see a move and it could be short, I'll just take a bet on one of these indexes. So you can see now that, the market is starting to diverge. So you can see for a while, the Dow, the value stocks went up and the technology stocks went down. Now you're starting to see that diverge. You're starting to see the growth stocks catch a bid and the Dow stocks go nowhere. So I would start buying value, growth stocks, technology stocks, and start selling like Procter & Gamble and Pepsi-Cola and, Minnesota Mining and maybe Boeing. Boeing has earnings this week, maybe. But you can see the Dow looks like it's topped out while the growth stocks are now taking off. So this is, I always say, it's not a stock market, it's a market of stocks. Qualcomm's going straight up and Procter & Gamble's going the other way. So it just understand what things are doing, find a risk reward rationale. Like I can understand Procter & Gamble. Even if I'm wrong, I know what my risk is. So I know exactly going into the trade how much I'm going to risk. So then it's, how much it's going to make, where it's going to go, those are unknowable. But if I can kind of understand my risk, then I'm a long way ahead of the game. So, if you short the stock here, this is your risk, right? So here's your key reversal. You can, short it into some kind of upward momentum, but this is your risk. Today's high is your risk. So it's come off pretty quickly already. So it's pretty dicey in here, but this is basically how I look at trades. Sean says, good explanation, lecture. So thanks for that, Sean. So I'm going to end this here. Tomorrow, I will give you a link to my book. That will really explain my 4-step trading methodology in greater detail. And, we'll look at some precious metals tomorrow, and we'll look at a different asset class. But really what I'm trying to show you is that you can use this kind of analysis no matter what asset class. If you're interested in Forex, if you're interested in currencies, if you're interested in stocks, this is a process that you can apply to any trading and asset class. So thank you again for showing up, and I'll see you back tomorrow, 4:30 Eastern Standard Time. Richie says, clearly explained. Well done. Thank you. Richie, you're welcome. Enda, you're welcome. Duncan, you're welcome. Thanks, buddy. Jason, Ollie, Francis. All right, guys, take care.
All right, see you tomorrow, Mark.